Would you rather spend $6,000 to get $9,859 or spend $15,000 and get $20,998? My name is Darius.
And I'm Carmen. In this video, we are going to break down money and your growth rate to determine exactly what it is that you should be determining how you should place your money. Because I know when we first got started out, if you're new to the Wealth Nation channel, welcome, pull up a seat. We always talk about our financial journey, the things that we've learned, and just the concepts that we feel have been super valuable to our lives.
Right. And before we get into the concepts, we just want to let you know ahead of time that we had a budget in place before getting to these numbers. So it wasn't something that we just got,
Threw out there
saying, hey, we want to start doing life insurance. We got $10,000. Let's just start doing it. Mm-hmm. What happened was we had a budget and we set ourselves up and we worked our way up to the point to where we could just get life insurance policies and use it to borrow to finance our lifestyle. And that's exactly what we're going to be talking about today, because what happened was we just taught a class to our money schools about policy design and policy splits.
Mm-hmm. Yeah. And to break that down a little bit more. So again, if you're new to the Wealth Nation channel, what Darius and I talk about is this concept of using whole life insurance as a savings account. And the reason why we talk about that is because one, there's a guaranteed rate of return. And then two, there's a death benefit in place. So not only is our savings guaranteed, but we also have a death benefit in case we should pass. And so in our money school, where we have hundreds of members, so we talk about how this whole process works and why one should do it and how you should apply it to your life. So if this is of interest to you, then definitely click on the link below. We would love to serve you at the Wealth Nation. So the numbers that we shared with you, we just got off talking to our money schoolers and we posed this question to them, which is why we're bringing it to you now on YouTube to just talk about it. Because a lot of times people would go, do I want to put $15,000 up or $6,000? Which one do I want to put up? They are different. And depending on your purse strings, you might be able to afford one or the other. So let's have that conversation. Would you rather put up $15,000 to get $20,000 or $6,000 to get $9,800?
Yeah, I'd rather put in the $6,000 to get $9,800 because if I look in between the lines, the growth is higher with the $6,000 than it is the $15,000.
Is it? And I'm playing devil's advocate. Is it, Darius? Because I put in $6,000 to get $9,800, which is just shy of $4,000. Or do I put in $15,000 to get $20,000, which is $5,000?
Right. Yeah. You put in $15,000 to get 20. Yeah. But when you take a look at how much more money you have more money, put it into 6,000.
I totally agree with you. And I'm just breaking it down again because we have our resident numbers brainiac person. And for me who looks at things differently, I know we just had this conversation and off the top, I actually would go the $6,000 route as well, but for a different reason. And for me, without having to do all the numbers in my head like you do, I would just be like, it's less money. I still get a great rate of return. That's probably what I would rather do because I could take the difference and invest in something else, do something else with it.
And what I'm looking at is just a higher interest. You put in money, you put in less amount, that's fine. Regardless if it's less or more, if you get a higher interest, a higher interest rate, then that's what you go after.
Yeah.
And that sparked the conversation of how are we talking about money? What type of words are we using when we're talking about money? Are we talking about just the dollar value, or are we talking about interest rates?
Yeah, I agree with you.
And if we take a step even further back, what conversations are the banks having about money? Are they talking about interest rates? The Feds. There's a lot of conversation going on around about interest rates and
especially now.
Yeah.
Get a house. The interest rates are ridiculous.
Right, and they're talking about inflation, and all these conversations are held around not a dollar amount but an interest rate, because regardless of what the dollar amount is, it could be a higher number or a lower number, just like we've seen, but the conversation we need to be having is the interest rates.
And before you go into that, I want to make sure we will go through the numbers with you so that we're all on the same page, but we just are having a little bit of dialogue about how we got to this number, how we got to this place before we give you all the deets. Just so you know, we're leaving you hanging just for a little bit, but hold on with us. So I like that. I want to stop you just for a moment because again, when we think about money, where we're all learning and coming up together, because these aren't things that we're taught in school. And so how do you learn this information? Because I know as consumers back in the day, we would look at an interest rate and go, okay, the smaller interest rate obviously makes more sense, but we also don't think about how much money we're putting in over time and how that all plays into our factor. I know, like when we bought our first house, we knew, what was our interest rate, like 3.7, something like that.
Yeah.
It was decent, and we thought we were getting a great deal. But then when we looked at the amortization schedule and saw over 30 years, we're like, wait a second, that 3.75
it looks like
horrendous.
Yeah. We doubled the payment in 30 years.
More than double the payment. So we're placing
double the cost of the house in 30 years.
Yeah. We're placing these nuggets with you, if you will, so that we can, again, come up together and start to understand how these things work, how interest rates play a huge factor in the bank's ideology, how they work, and how they continue to make money.
Right. Because the reason why we're having this conversation now is we want you to take a step back. How much interest, not your monthly payment, not how much is your monthly payment on your car note or your credit cards, how much interest are you paying? Would you rather pay a higher interest, or would you rather pay a lower interest? Because depending on how much interest you're paying, that determines the dollar amount that's actually going to pay the principal off. Because let's say you have $100 and you have something that's at a 20% interest, like a credit card, for example, you automatically think that, hey, $20 is paying interest and $80 is going towards the principal. That is not the case. That is not the case. What's really happening is a lot of times our interest is just stacked up on the front end of our notes and things of that nature. Is never really the interest that we think we're paying.
No.
So if we can change our conversation about how much interest we're paying and get a better understanding of interest and how it works against us, we can switch it so that it can work for us.
True. And going back to interest on a credit card, again, just thinking about where are you looking as far as the numbers go? Are you looking at the interest rate, or are you looking at the minimum payment?
When you set up your budget, are you just looking at your minimum payments, or are you also taking into consideration the amount of interest you're paying on each specific minimum payment that you're looking at?
And one of the few things that I agree with Dave Ramsey on is he was talking about broke people look at the monthly payments, rich people look at the total amount. And when you break that down into your own perspective, you realize that if you're only looking at things from a minimum
payment,
a minimum payment standpoint, you can't afford whatever object it is that you're trying to get in the first place, and you're paying someone significant amount of interest to have that object in your possession. So you have to really start doing the math and understanding how these things work.
So I want you to say that again. If you are looking at the minimum payment, then you can't afford it.
Yeah.
If you're
looking at the minimum payment, you cannot afford it.
There we go. So when you go to purchase your new car, you're asking, hey, how much is the minimum payment on this if I get this finance? You can't afford it.
How about your house? Wait a second.
Yeah, you can't afford it.
Yeah.
If you go to buy a new pair of shoes and you do the afterpay and you look at the minimum payment,
don't get me
you
started.
cannot afford those brand new pair of shoes. So let's rethink or change our vocabulary, because that's a start. Changing our vocabulary changes the way we think.
You're right. Wealth is a mindset. I like that shirt.
Mindset.
Did you mean to wear that shirt today because you knew what we were talking about?
I did that intentionally.
So going back to that, change your vocabulary. I love that you say that, because instead of saying, oh, it's only $100 a month, oh, it's only $1,000 a month, change your vocabulary to, that house costs $300,000. Can I afford $300,000? That car cost $50,000. Can I buy a $50,000 car?
Afterpay for those brand new pair of shoes,
them J's,
8%. Can I afford to pay 8% more than the cost of this pair of shoes so I can have it immediately?
Nope. Because already the value of whatever it is that you're financing is more expensive than the cost of the goods.
Right. So as soon as you can start curbing the conversations you're having about interest, and look at how much interest you're paying, then you can start refocusing your energy on how much interest you can earn.
Bingo.
Because you can't earn interest if you're paying it.
Ooh. One more time. You got to say that one again.
You cannot earn interest if you're paying interest. The idea is to stop paying interest so you can convert those into interest that you're earning.
Yeah. And again, ladies and gentlemen, the point of this video is just education. We're just having a conversation about money because really nobody's having these conversations about money. We don't sit around our dinner table anymore and have conversations with our family about money and how things should work. So we want to have conversations with you, hence the YouTube channel. Right. So Darius and I, all the time, we just have dialogue about interest rates and how things work and you know, just what's going through our head. So we wanted to share this with you because we were inspired by the class that we just taught and said, you know what, we need to come on YouTube and unpack some of the things that we just addressed today with our students.
Right. And one of those things was, what's the difference in the policy splits? What policy split is better than the other?
Yep.
Well, it depends on your situation and what you want to do because, hey, you're going to have your life insurance policy the rest of your life. So you have to look at the 5 year, the 10 year, the 15 to 20 to 25.
Yeah.
Because one thing the insurance company,
you have to look at those years.
Those years. One thing the insurance company knows about you is they know your health and they know generally when a group of people is going to pass away.
Yeah.
So what you're doing when you say, hey, I want to do this for 5 years and then I'm done, well, what you're doing is betting against the insurance company. And one thing you don't want to do is bet against somebody that has more money than you do.
And when you mean bet against the insurance company, when you get life insurance, you have to go through a medical exam. And so you're giving up your blood, you're giving up your urine, and they ask you all sorts of medical questions because the insurance company is trying to determine your insurability, aka can they invest their money in you to provide you with a death benefit. And 9 times out of 10, if they give you a life insurance policy, congratulations, you are healthy enough to be able to be insurable. If you are denied, then you may need to go figure some stuff out with your health because the insurance company is not putting their money with you. So just think about that. Again, if you're denied, you need to change something about your health. If you're approved, great. And if you're approved, you need to make sure that you're as efficient as you possibly can be with your money because you don't want to bet against the insurance company and stuff a whole bunch of money into it inefficiently so that at the end of the day, they end up getting all of your money. and don't get me wrong, there is nothing different between life insurance companies and banks. At the end of the day, they are for-profit institutions. But we need to be as strategic as we possibly can so we can get a guaranteed rate of return and we can get a death benefit that'll protect our family.
Right. And here, let's bring this full circle. If this is your first time visiting our channel, the reason why we're talking about using a life insurance policy is because we borrow from life insurance policies to finance our lifestyle. So instead of changing the product or how we invest, if we're investing in the stock market, if it's Bitcoin, if it's real estate, if it's cars, whatever it is, we're not changing the actual vehicles we're using. We're just changing the environment in which we use them. Because what banks do is banks give us access to a pool of funds that we put into their banks, that we stored into their facilities, and then they charge common interest to get access to money that I put into it. Now, what banks also do is they borrow blocks of money from life insurance companies, and then they charge you interest, and they pay the difference to themselves. So they borrow money from a life insurance company and a block of money, say at 5% interest. They charge you 20% interest for your credit card, borrow that money, and they keep 15, and they didn't have to put up any money for that.
Sounds like an amazing business.
That is an amazing business, but the nice thing about it is we can do the same thing if we store our money inside of a dividend-paying whole life insurance policy that's participating.
Yes. And just to reiterate, I know Darius already said it, but I want to reiterate, all we're doing is changing the storage facility in which we put our savings. We're not investing. We're not doing any of that. A lot of times people confuse this. All we're doing is moving our savings from a savings account at the bank and putting it with a life insurance company. So that way we can guarantee our funds, and then we can then use those funds, leverage them to invest. So it's just a more efficient way of using your money because it's protected and you're able to use the insurance company's money to invest instead of using your own.
Right. So we're still doing the exact same things. We're still borrowing money and we're still paying it back with interest, just like we're using a bank. The only difference is we're paying it back to ourselves and we're keeping the interest so that we can reuse those funds to lend and borrow more money.
Continue doing it again. Now, to further this point is what we were just teaching in our class is there's been a hot topic for several months now about policy designs, how policies should be designed, how you should allocate the funds. And so we decided to take the time to educate our students on which policy design or AKA split makes the most sense. So whenever if you're thinking about getting a policy, you have to make sure that first and foremost, the agent that you're dealing with is actually actually doing this themselves so that they can continue teaching you and educating you how this whole process works. The next thing you have to take into consideration is just because you see how one policy is designed online doesn't necessarily mean that it makes sense for you, because the other factors that take into play are your gender, your age, and your health. And we can't assume that everyone is the same across the general statement here. And then also your premiums are going to take a big play into this. The more money you put into this, the more you can do. The less money you put into it, the more stringent we have to be. So don't ever just look at one scenario and be like, that's what I want to do, because it may not make sense for you. You can obviously bring it to your agent and have a conversation about it, but just be open to knowing that there may be other options that might make better sense for you in your particular situation.
At the end of the day, what you want to do is make sure you do your due diligence ahead of time so that you can have a conversation about what you're trying to accomplish with your system.
Yes.
Because that makes it easier for the agent that's going to be working with you on your particular case to create something that is for your specific needs.
Absolutely. So to go back to the numbers that we shared with you at the beginning of this video, is we were comparing two policy premiums, a $15,000 premium versus a $6,000 premium. And this is after 10 years of your banking system being in play. So at the end of the day, actually, and not to confuse anyone too much, but both the premiums are actually $15,000 premiums. One just got significantly cheaper over time. So over time, we still have to pay $15,000 in one hand, but the other policy now got cheaper and we only have to pay $6,000.
Right.
So what we recognized was after 10 years, not only does one policy get significantly cheaper, but the growth is greater, even though we're only putting in $6,000 versus $15,000. Right. And so with the premium that was $15,000, the growth between the 9th and the 10th year of that policy was $20,000. And then the growth between the $6,000 premium with that 9 and 10 year mark was $9,800. So that's why we want to ask you, which one would you go with? Everyone's scenario and circumstance is going to be different. We're just kind of throwing it out there just to start the conversation and have people start thinking about the things that they would want to do. And so I know for me, the conversation that I had, if I can put in less money to have a greater growth rate, then that's exactly what I want to do. And what those policies grew to, let's talk about the $15,000 premium. We put in $15,000 and in year 10, that grew $20,000. So that growth rate was what?
About 139%.
Okay. Now let's compare it to the $6,000 premium, and over 10 years, that 10-year mark, the policy grew to $9,800, and that growth rate was what?
164%.
Yeah. So we have 139% versus 164%.
Now, the 139%, we have more money, but we put in more money.
Yeah.
With the 164%, we have less money, but we have a higher rate. So me personally, I don't care about the I don't care about the dollar amount. What I care mostly about is the interest.
Yep. What is the return? What am I getting back? Or what did the growth grow to? So that's why we want to challenge you all today is start thinking about money in a different form. One thing that we talked about from a consumer standpoint, do not look at minimum payments, look at the entire payment and figure out if you can afford something. If you can't, then we need to reallocate some funds to make it where you're not financing something and having to pay a ton of interest unless you're financing it yourself and keeping it within your banking system. And when you get to the point where you are no longer paying interest, you're earning interest, you need to be able to do another set of math to make sure that you understand how much money you're getting so that you can make your money grow as efficient as possible.
Right. Now, all this came as a result of the class that we just taught inside of our money school, where we were teaching our clients how to read different life insurance policies and how to determine which one is the best for you. So if that's something that you're interested in becoming a part of, definitely join the money school. The link is in the description below, and we would love to have your input and your feedback inside of our class.
Exactly. So Wealth Nation, today is all about changing your vocabulary, looking at numbers and reading between the lines. So we challenge you today to start looking at your finances differently so that you can start making sure that you are earning interest instead of paying it. Now remember to own your own lifestyle.
Or someone else will.